We all have that dream, don't we? To be the perfect investor. To somehow know exactly when to buy at the absolute bottom and sell at the absolute top. It's the holy grail. But what if I told you that chasing that perfection is probably one of the most destructive things you can do for your long-term wealth?
So let's get real. What is the actual cost of trying to outsmart the market? When you look at nearly 100 years of data, the answer isn't just surprising, it's absolutely jaw-dropping. To really wrap our heads around this, let's do a little thought experiment. Imagine you invested in the US stock market and just held on for 90 years. That's right, 90. From the depths of the Great Depression all the way through the craziness of the COVID pandemic. You just buy and you hold. That's it. So what's your total return? A mind-bending 17,715%. And no, that is not a typo. That's the raw, almost unbelievable power of just being in the market and letting time do its thing.
Okay, but now let's add a little twist. You decide you're going to be clever. You're going to try to time the market, jumping in and out to miss the bad stuff. And in that process, you make what feels like a tiny, insignificant mistake. You just happen to miss the 10 best trading days each decade. That's only 90 days out of more than 22,000 trading days, a tiny fraction. So what happens to your return? It completely collapses. It goes from over 17,000% all the way down to just 28%. Think about that. By missing a mere 0.4% of the days, you lose pretty much all of your potential wealth. This isn't just a bad outcome, it's an absolute financial catastrophe. And that, right there, is the core paradox of investing. Our gut, our intuition is screaming at us to get out and avoid the scary downturns. But the math tells a completely different and much harsher story. So why does this happen? Well, here's the secret. The market doesn't hand out its returns in a nice, smooth, even line every day. Not at all. Instead, the gains are massively concentrated in a very small number of explosive, super powerful days. Missing these few days isn't just missing some of the gains, it's missing pretty much all of them. And this devastating principle plays out over and over again. It's true for the good decades, but believe it or not, it's even more true and more important for the bad ones. This effect is at its most powerful when times are toughest. Just look at the 2000s, what people call the lost decade. If you stayed fully invested, you would have had a 24% loss. Painful, for sure, but you survive. But what if you missed just the 10 best days of that decade? Your loss balloons to a catastrophic 62%. This tells us something absolutely vital. The market's best days aren't just for racking up profits when everything's going great. They are the essential recovery days that stop the bleeding during a crash. They are your financial life raft, and you have to be in the water to catch it.
Right, so now you're probably thinking, okay, I get it. I'll just make sure I avoid the worst days. Simple, right? Well, there's a huge problem with that logic. The thing is, the best days and the worst days, they're almost always neighbors.
There's actually a name for this. It's called volatility clustering. It's a fancy term for a simple idea. Huge market swings, both the good and the bad, tend to get bunched up together in really tight windows of time. You can't just surgically remove the bad days without also taking out the good ones. They come as a package deal. And the data on this is crystal clear. Over the last 20 years, 7 of the market's 10 best days happened within just 2 weeks of the 10 worst days. They're practically joined to the hip. I mean, just think back to the absolute chaos of March 2020. On March 12th, the market just fell off a cliff, a drop of over 9%. It was pure panic. But the very next day, March 13th, it staged a massive rebound of over 9%. If you panicked and sold on the 12th, you locked in that brutal loss and completely missed a historic recovery that literally started less than 24 hours later. There's a great analogy for this. The panic of the thunderstorm and the beautiful relief of the rainbow, they're part of the same weather system. You can't experience one without being there for the other. So, if the data is this obvious, why on earth do we keep making this same mistake over and over again? Well, the problem isn't in our spreadsheets, it's in our skulls. It's a costly glitch in our own human brains. You can actually measure this. It's a phenomenon called the investor gap. Over a 30-year period, the S&P 500 returned about 10.7% a year. But the average investor, they only made about 7.1%. That 3.6% difference every single year is the price we pay for bad timing driven by pure emotion.
It all comes down to how we're wired. We suffer from something called loss aversion, which means a market drop feels about twice as painful as a gain feels good. That triggers our primal fight or flight instinct to just sell everything and run for the hills. Then, emotional anchoring kicks in, and the bad memories make us too scared to get back in, so we miss the rebound. Our brains are basically designed to buy high and sell low.
So what's the solution to all this self-sabotage? Well, it's incredibly simple, but it is not easy. The winning strategy is to focus on time in the market, not timing the market.
Let me just leave you with this one last devastating piece of data. A $10,000 investment over 20 years grows to over $70,000. Pretty great. Miss just the 10 best days, that number gets cut by more than half. Miss the 40 best days, that's just 2 a year on average, and you've actually lost money.
So at the end of the day, it all comes down to two paths. You can choose market timing, a super high-stress, statistically impossible game of trying to predict the unpredictable, or you can choose time in the market, a disciplined, simple, and historically proven strategy that relies on patience, not predictions.
And that really leaves us with one final crucial thought. We spend so much time and energy worrying about market crashes, recessions, and what the headlines are screaming about. But what if the data is showing us that the single biggest risk to our long-term financial success isn't the market at all, but the person looking back at us in the mirror?